Welcome to the FitBucks podcast. I'm Joseph Ranke. If you are watching on YouTube, welcome as well. Today we are going to be discussing one of the topics that I see people get confused about all the time. And if you make a mistake on this, it can actually end up costing you a lot of money, okay, one way or the other, okay? And that topic is student loan refinancing versus student loan consolidation. So that's what we're going to be talking about today in this episode. Before we start going, if you're listening on the podcast, be sure to subscribe to it, share it with your friends. If you're watching on YouTube, like it, share it, comment, subscribe to the channel. Again, it helps us, it helps you to know when new episodes come out, and it helps get the word out to your friends as well. So thank you again. And with that, let's jump right into it. I'm going to start off with student loan consolidation. And again, the reason why this topic is so confusing, just to give you some background, is back in the day, prior to the invent of like technology and computers, so like 10 years ago, it wasn't uncommon, like when you had student loans, like if you had 10 to 15 student loans, you could potentially have like those loans at 3 or 4 different places. And it can get really, really confusing. And you used to literally have to write a check and pay off each one of your loans. And so the general idea with the federal government was, hey, consolidate your loans. And I'm going to explain to you what that means in a minute. And the whole purpose was to basically make it your life easier, because your loans would all be at one place, all one loan, and you didn't have to worry about writing 4 checks a month, right? Obviously, with the advent of technology, we don't have to do that anymore. You can put it on auto pay, and not only that, but most of you are going to have one company. But you can just set it up on auto pay. So even if you have 2 companies, just set it up on auto pay. You don't have to worry about it anymore. It comes straight out of your bank account, right? So that was the old reason why they used to say consolidation. But the reason why I wanted to bring that up is because student loan refinancing versus consolidation, it's really confusing, because when the student loan refinance lenders launched, so like some of our partners such as like SoFi and Common Bond and Earnest and Splash and Laurel Road and these companies that we partner with to do student loan refinances, like SoFi was the first one. I think Common Bond and Earnest, they rolled out. And what happened was that they would say that the word consolidate your student loans, even though they actually meant refinance your student loans. And I don't know why they did it. I have an opinion of why they did it, and the opinion is that that's what the industry was used to hearing from their federal loan servicer, Consolidate. So they just said, hey, consolidate, and that saves you money, which in actuality it doesn't. And they're not necessarily lying in terms of saying consolidate, but they were not necessarily being truthful about the benefits of what you were actually doing. And so it causes a massive amount of confusion. Okay, so with that background, we need to actually understand what is student loan consolidation and what is student loan refinancing, and why, if you make a mistake on doing either one of those, it could potentially cost you a lot of money. So with that, if you're watching on YouTube, I'm going to jump into one of our demo profiles here on fitbucks.com. If you're listening on the podcast, I will just read off some of these numbers and whatnot to you. So on this profile, I'm going to go into one of our tools. This demo profile, this individual has a hypothetical $153 in loans, and they have about 8 different loans. Okay. Now, what consolidation means is this person has loans that range from interest rates of 3.4% all the way up to 7.9%. And so if you actually look at what's called a weighted average interest rate of all of his loans, it's about 6.7%. Okay, that's the overall interest charge that this person is paying on their loans. All consolidation means is that you take all these 8 loans in this example and you merge them into just one big gigantic loan, okay? So instead of having all these individual loans, you would have one big loan at $153,000, and the interest rate doesn't change. It's 6.7%, and that's one of the keys when we're talking about refinancing versus consolidation. The interest rate does not change, okay? Your monthly payment overall stays exactly the same. Consolidation doesn't save you money in and of by itself. It doesn't do anything to get you out of debt sooner by itself. It literally just means merging the loans into one big loan. Now, why is this costly to do? And why, if you stay in your federal loans, do you probably not want to do this? Okay. First and foremost, if you're making prepayments, you want to be able to allocate those prepayments to a specific loan. So like in this example, like I have a 7.9% interest rate. So if I stay in my federal loans, I want to target that 7.9% loan with my prepayment and pay that one off early because it's going to save me the most money. Once I consolidate my loans, I can't do that anymore because I just have one big payment every single month and I have one big loan. I can't divvy up where my prepayment goes anymore. So therefore, it's going to cost you money. And for example, at $153,000 in this example, with their interest rate ranging from 3.4 to 7.9, if this person was making about a $200 prepayment every month, it would end up saving him about an extra $5,000 if you targeted the specific interest rates correctly versus if you didn't. Okay, that's why it's so important not to consolidate if you stay in your federal loans. Now, another reason is every time you pay off one of these loans, let's just say this first loan I paid off, the part of my monthly payment that's associated with that is $245. So if you recall, my overall required payment is $1,754 a month. All my 8 loans have an individual monthly payment that adds up to that dollar amount. Well, if I focus and I pay off this first loan first, my required payment would drop by $245. So instead of being $1,750 a month, it would go down to about $1,500 a month. Why is that important? Again, it's one of those things where it just frees up money in your budget just in case, so you have more budget flexibility. That's one big reason. The second big reason is, for example, if you're trying to buy a house down the road, the lower your required payment is on your student loans, the easier it is to qualify for a home loan. So you might be strategically trying to pay off some of these loans so you can drop that required payment. Once you consolidate your loans, you can't do that anymore. You literally have one big loan for one loan payment until that balance goes to zero. So from $153,000 down to zero, you got one large monthly payment. Okay. The third reason, and this is more of a technicality on the way student loans work. Once you consolidate, you're considered in a brand new loan. Okay? Why is that important? We don't know what's going to happen with student loan repayment plans in the future. And there might be an instance where a new type of repayment plan comes out that is actually better for you than the one you're in. If you haven't consolidated yet, there's a possibility that you could consolidate at that time and take advantage of the new plans that are better. Okay. Now, is that necessarily going to happen? Who knows? We don't know. But we see it all the time. People like 5, 6, 7 years ago that consolidated because their loan servicer, they called them up and say, hey, you should consolidate. So they did it. And the new income driven repayment plans come out and they're actually better off. They should be in those ones, but they can't switch because they already consolidated their loans. There's nothing they can do. Whereas other people that didn't do that could consolidate, and sometimes they can go into the better plans. So that is why you would want to consolidate. Is those 3 primary reasons. One, it could potentially cost you money because you can't target the high interest rate loans anymore or any specific loan. Second of all, you have one big monthly payment for the entire time period of your loans. And third of all, it limits what you can potentially do in the future. Okay. Now, one reason why I said earlier that consolidation doesn't save you any money or it doesn't do anything to the loans, it doesn't drop your required payment, it doesn't do anything. I wanted to bring that up again because a lot of times people get confused. They're like, I consolidated and I'm saving money. It's like, first of all, you did something else, which is refinancing, which I'm going to touch on soon. But oftentimes you'll hear people say, I consolidated and my monthly payment dropped. The consolidation didn't cause their monthly payment to drop. What they did was they went from a standard 10-year plan to a 25-year plan. And so because of the extension of the loan, that required their monthly payment to drop. Not because they consolidated. Okay, so I don't want you guys to be confused about that because I hear that all the time as well. Now, before we go into refinancing, I want to close on consolidation because 99% of the time you're not going to want to consolidate if you stay in your federal loans. So what is that 1%? Every once in a while at FitBucks, we will run across someone that would be better off in a plan, like a relatively new plan, but they can't qualify for it because their old loans were taken out at a specific point in time. So it goes back to point number 3. In that situation, those individuals could consolidate and go in because they have a brand new loan. Then they can go into the new plans and take advantage of the better terms. Okay, now we don't hardly ever see that, but that's why you'd want to, is if consolidation allows you to get better terms on your repayment plan or allow you to qualify for a specific federal repayment plan. Oftentimes we see that when people are trying to go into an income-driven repayment plan. Most of the time when we see that. So that's the only time you'd want to do it. Again, we hardly ever see that. Bottom line is, for most of you, if you stay in your federal loans, do not consolidate. There's really no benefit to it for you, and it can actually potentially end up costing you money. So student loan refinancing versus consolidation, that's what this is about. So we need to talk about student loan refinancing. What is it? Going back to this demo profile, I have these different loans, 7.9, 7.8, 7.2, so on and so forth, right? Now, let's just say I'm working and I have a job and I graduated and I say, you know what, I want to save some money. What you do is you go to a private lender. So for example, our free student loan refinance service, we go out and we help you shop 10 different student loan refinance companies. So you probably got ads from these companies. So like SoFi, Laurel Road, Splash, Earnest, Common Bond. Those are all of our partners. And you would go to them. Those are private companies. And you say, now that I have an income and I've graduated, will you give me a lower interest rate? And if they say yes, and you agree to it, then what they do is literally write a check and send it to your federal loan servicer and pay off your old loans or your private loan servicer, like if you have other private loans. They literally write those companies a check, pay off your old loans, and you would have a brand new loan at a brand new company at a lower interest rate. Okay? So again, the key to that is that with consolidation, you're just merging the loans. With refinancing, you're completely replacing the loans, your old loans, with a brand new loan at a lower interest rate. The whole point is to try to save money. Now, it might not be that cut and dry and easy because there's some stuff with student loan refinancing where you give up some federal benefits and all that stuff, but that's why we have our free service, is before you go out and refinance to make sure it's right for you. And that's not what this podcast is about. But if you guys need help with that, just let us know. We can help you with that. But that's the point of refinancing, is to save money. And if you're paying off your loans, every single one of you should look into it. Okay, it doesn't mean you're going to do it, but look into it. Okay. Now, some other things about student loan refinancing. Again, the purpose is to save money. Oftentimes, we'll get the question like, why would a lender, want to do that? And a lot of times, people are thinking about that because it's like, hey, 7.9%, 7.8%. Why would somebody want to give me 3%? And it's not the same lender that's going from 7.9 to 3%. Because trust me, the federal government, that's getting the 7.9% on your loans, they want that 7.9%, right? They don't want you to pay that off, because then they don't get that interest anymore. The 3% is coming from a brand new company. And the way you got to think about it is that company is sitting on a huge pile of cash earning 0%. And so because of where the market rates are, maybe 3% sounds good to them, maybe 4% sounds good to them, maybe 3.5%, whatever it is. And that's why it's like, hey, here's your offer. And if you accept it, it's good for you because you save money, and it's good for them because they went from making 0 to making something, and they're happy with that. Okay. So that is why companies would refinance to begin with. Now, why is refinancing and consolidation so confusing when people get it confused? And why earlier in the podcast I said, when those student loan refinance companies say, hey, consolidate your loans with us, it's kind of a twist on words. They're not lying, but they kind of are. Why did I say that? Okay. When you refinance, okay, oftentimes you merge your loans together. So you consolidate at the same time. Okay. So like in my example, again, I had $153,000 of loans. There's 8 different loans. Let's just say, the company's going to give me a 3%. The new refinance company's going to give me 3%. So in my case, I'd refinance all my loans. That means they would give me one big loan of $153,000 at 3%. Okay. So I refinance and consolidate at the same time. But that also brings up a key. You don't have to refinance all your loans at the same time. So let's just say in my example, I have 2 loans at 4.2% and another one at 3.4%. And so they say, okay, well, we'll give you a 4.5% loan. So what I would do is I would just refinance 6 of my loans, and they would consolidate those into a $140,000 loan. And then I'd have 2 other loans, one for $8,000 and one for $5,000 at the federal government still. But we see people do that all the time. Prior to COVID, we used to see that all the time because that's how the interest rates were. There's oftentimes a mix, which was good to refinance and what was not. Now with COVID, interest rates are so low. We're seeing most of the time people just refinancing everything. But interest rates are going to go up, and guess what? You're not going to want to refinance all your loans. So again, that is the podcast today and the YouTube video today. Consolidation versus refinancing for student loans. Just to reiterate, consolidation, if you're staying in your federal loans, you most likely do not want to do it 99% of the time because it can cost you. It can make it so that way you have one big payment for all these years. It could hamstring you down the road. You don't want to do it if you don't have to on your federal loans. Refinancing is if you say, hey, look, I want to completely go out into a brand new loan at a lower interest rate, potentially save some money. That's when you would do that. Sometimes when you refinance, you also consolidate at the same time. That's why it's so confusing. If you guys need help with student loan refinancing, I'll put a link in the show notes as well as in the description for the YouTube video about our free student loan refinance service. And if you guys just need help with student loans, trying to figure it all out anyways, you know how to get a hold of us. Fitbucks.com, click join now, build your profile, schedule a call, talk to a coach. We'll get you on your way, ready to go. We'll see you next time.